Welcome back, and if you're just joining us, you're watching Closing Bell West Africa. Now, following today's 600 billion naira bond auction, the chief executive of ECOB Capital, Emmanuel Odiaka, says expectation is that the debt management office will need to allow stop rates to align more closely with prevailing secondary market levels, potentially in the 16.8 to 17.2% range for the January 2035 bond, while noting attempts to artificially suppress yields may lead to weak bids to cover ratios or reduce investor participation. Now, looking ahead, he also expects the Monetary Policy Committee to leave the monetary policy rate unchanged at 26.5% in this week's meeting. He joins me now for more on these. Thank you so much for joining us on the show today, Mr. Odiaka. Do you really believe we will see the DMO finally allow yields to clear at market rates, true market rates, or you think it's just going to be the regular go-to around yield suppression?
Well, that we would wait to see. I'm not the DMO, but market is speaking out already and calling for higher yields. Comparatively to the yield curve, if you look at OMO printing 21.5% effective yield, you look at what the monetary policy rate is at presently 26.5%, and you look at NTB 1-year yield that is also printing at the 19th percentile levels. That clearly shows you that the bond yields presently on the curve trading at between 16.8% to 16%. And when you look at market reaction, penultimate last auction, which was April auction, when the 2035s and some other maturities was printed, and we saw a market reacting, very, very negatively to the outcome of that auction, where we had the stop rate for the 35s printing at about 16.57% thereabout, and secondary market was trading quite higher at 16.65. Immediately after the auction, market didn't adjust. Market tend even higher. That was a market that was becoming frustrating, and we would like to see the DMO print rates at prevailing market rate instead of trying to, adjust costs to suit itself.
Let's also shift the conversation a little bit towards liquidity now, and then the role of banks and the domestic demand we have now. Yes, Nigerian banks are the typical dominant players in the purchase of government securities, but would you say we are getting to a saturated point where banks' balance sheets can no longer absorb more government supply?
No, not at all, David. Banks will always be interested in holding debt instruments at very, very good yields. Well, when you look at the open market operations and you look at the interbank rates, which are presently printing between 21.5% and 22.5%, banks will not be interested in holding duration assets at 16.5%. So it's a question of where the prevailing market yields are on the curve, and the alternatives that the banks are having. Banks love, assets that will make them feel comfortable because of revaluation issues.
And one of the conversations I had at the close of last week was what inflation print would likely trigger the bond market into a nervous sentiment to trigger enough of a sell-off. That was one of the questions I was having. But now let's look at if inflation still proves sticky into the second half of this year, could we see some structural, should I say, repricing of the entire yield curve?
Yes, certainly. Market takes inflationary issues very keenly, and while we do not anticipate a surge, such a surge in the near term, we have to keep our eyes on geopolitical risk factors, especially with the ongoing conflict happening in the Middle East. Our eyes must be on the crude oil market. We have seen markets reaction both on the Eurobond segments, where there has been sell-off, and with the ceasefire ongoing, we have seen market repricing such assets also. And let's not forget that with the yield curve also have impacts it has on the foreign exchange market. We have not seen much sell-off. The market has been very stable to a large extent, although we are not seeing much of FPI's participation in the curve. although, yeah, seems more like they have been playing on the equity space. But one wants to look closely at those thresholds in the coming weeks, because, of course, yes, aside from monetary policy rate fixing by the monetary policy authorities, market wants to also see that its carry assets is positive in carry when they analyze their positions.
And you also talk about the MPC likely to hold rates. If they don't, what do you think would happen? Market signals?
Well, I think they have little choices right now, David. The choices is now about stability or trying to reflect the economy. The economy is doing very well, although yields, borrowing cost, capital cost of fund is still very high and elevated. But I think the MPC would choose stability as against taking any other form of risk. The B matching system, or what we usually call the I&U window, has been at a very printable, convenient place, and we have seen stability in FX pricing, ranging from 137 levels to 18 levels, and the parallel market cash stable at 1,400. The MPC will continue to keep an eye on this. In anticipation to the MPC communique tomorrow, we would call for a hold. Looking at the geopolitical risk factors, how crude oil prices has impacted negatively to inflationary pressures, and how that has affected both transportation, both supply chains, relative costs, and the domestic supply market also. Once transportation is affected, of course, you know what happens to food prices. They tend to jack up immediately. So I think the MPC will be keeping an eye on that. And let's not forget also that domestically we are heading into an electioneering period, and I don't think they will want to jolt market. So the most we will be likely seeing is a hold. I don't expect them to cut in a situation like this. And I also don't expect them to hike yield, even in anticipation that there might be some structural pressures in the near term.
Okay, Mr. Odiaka, we'll leave the conversation here for now. Thank you so much for your time. That was Emmanuel Odiaka, the Chief Executive of ECOB Capital. You're still watching Closing Bell West Africa. When we come back, we'll be looking at the future of car financing in Africa. Don't go anywhere.